Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro, technicals, and a touch of crystal ball gazing. Today is Monday, March 3rd, 2025. Today's episode begins with tips and gold. I recently brought up this chart before, tips versus gold price, and how usually this normally will move together because both tips, treasury, inflation protected securities, which are U.S. bonds protected by inflation, versus the price of gold, another inflation hedge. And I just wanted to note on today's show that we've seen this little bit of a divergence between gold and tips really since February 20th. We've seen gold going down and down and down, while tips is going up and up and up. And as I've noted in previous shows, we've had a humongous divergence begin in April really of 2022 when tips had been collapsing while gold remained steady and continued much, much, much higher while tips remained relatively dead. And just very recently we're seeing this reverse, a little bit of jaw closing, as you will, of the alligator mouth. Reversion is a powerful trade, and maybe this is the beginning of it. I don't know. I can't find the article that I saw earlier. It was from one of the major banks, some CEO or major strategist of the bank saying the fear of bonds is actually over now. And I mean, yeah, bonds have been outperforming a heck of a lot of other assets for a little while now, since it's bottomed really. Will it continue? Anyone's guess. Next agenda item, the 10-year 3-month inversion is continuing to deepen, suggesting that the bond market, the supposedly smartest money out there, the bond market is supposed to be the smart money. It's when it gets inverted, it's saying, hey, Fed, you're going to have to cut. You're going to have to lower rates, because right now the amount that you can get on a 10-year long contract between you and the U.S. government, the amount of return that you can get is lower than what you can get now overnight, which is, it's abnormal. If you're going to lend to somebody for a longer period of time, you need a higher rate of return. And that's, now that we're inverted again, the market is saying, hey, Fed, we need more cuts. And, I was very curious to see if we would, bounce right back up into an uninverted state above zero with a 10-year minus 3-month. And instead we're continuing to deepen here. I mean, part of this is obviously that, the 3-month Treasury bill does not signify that there won't be, more cuts sooner, because it's only 3 months away. It's still saying for 3 months we're staying at this rate until it changes, until we get to that point where it's cut. We didn't cut enough. Let's keep cutting. We got to cut faster. Again, fiscal dominance does not only affect inflation not getting under control from raising rates, but also when lowering rates, it won't slow down the deflation on the other side of a fiscal dominant situation. This is the piece of the puzzle that is being widely ignored, and I think is not wise to ignore. Next big report, last item on today's agenda, Friday, we have the jobs report, the unemployment report, the report that triggered the SOM rule, which every time before the SOM rule has been triggered said that there was a recession. This was triggered in June, and we've been saying very steady around 4%. We'll see what happens with this report. No major changes in the daily reminders. Watch macro update to 11:25 to hear me explain what I think are the most important things for investors to be highly aware of on a daily basis. I will likely do an update fairly soon. As long as I'm doing this show, maybe I'll start doing something like the first of every month or something. I'll just do a macro update no matter what. I'll figure it out. Also, if you want to watch Portfolio Update 211, that explains my crystal ball ratings and my own investment portfolio. I very recently got another mega donation. Thank you so much for the donations, guys. I love it. I love the support, and all the support. Thank you for watching. You can always support with your 2 cents right here. And thanks for the views, the subscribers, and the donations. Much appreciated. All right, so let's move on to the charts. What a wild few days we had. Thursday, the S&P 500 going down 1.6%, and then Friday going back up 1.4%, and then today opening higher and closing lower than the previous candle. For me, this is a very, very, very bearish signal. The fact that we were able to engulf this very large green candle on Friday, this is going down with pretty high probability right now. We have this momentum here, plus the big red candle. The bulls tried to take control, and the bears just slammed it down. It's like an MMA fight. The bears are in control right now, period. This is supported by the VIX continuing to gain momentum to the upside. You never know when the VIX is going to top out and fall over, but right now it is looking bullish. I expect more volatility continuing through the week. Something that I didn't mention, it's estimated now, by the way, Q1 of 2025 has negative 1.4% GDP. I'm standard corrected here. It's actually 1.5, negative 1.5. This is shrinkage. If you have two of these in a row, quarter by quarter, that's officially recession, by the way. So this headline from CNBC, the first quarter is on track for negative GDP growth, Atlanta Fed indicator says. And this came out on Friday. I mean, if a recession is happening, risk assets tend to go down in price, and it looks like Mr. Market is getting scared probably of this more than anything right now, is what I'm sensing. Anyway, anywhere you look, Dow, NASDAQ, whatever it is, very big down days today. Russell 2000 dropping by 2.73% with a large engulfing candle to the downside. It's like, where does it end? It's going down. We're headed lower. That's what it looks like it's doing very clearly. SMH, Semiconductor Index, looking very, very bearish at the moment. I don't know when the dip buyers will come, if they will come. It wouldn't make sense for them to come, with these PE valuations being so enormously high, just for you to lose all of the incredible amount of speculative value and go down to any kind of normal sense of valuations in stocks. This is going to be dropping by a lot. Not a little bit, a lot. Meanwhile, TLT, my favorite place to be, like I've said in many shows now, after cracking out of this parallel trend line, jumping over the river, continuing to look more and more bullish, healthily bullish. This is not like blow off top looking. This is like we're trying we got sellers or the buyers take over. Sellers, buyers take over. The bond market's looking strong here. Similarly, the TNX, the 10-year Treasury yield, losing yield, looking like it's going down. I mean, we have this little support level here at 4.15 about, so I don't know, maybe we'll get a bounce here at the very least. But just on this movement alone at the tail end of here, I kind of expect it to continue lower. I mean, it looks like that's what the chart's telling me, at least right now. Also, a leading indicator of yields themselves, oil dropping humongously today, engulfing the last 4 candles completely to the downside. As I've said before, it's not an error, by the way. A commenter mentioned the target on here after we break this line, or if you make it a flat line, it looks like it might be around 65. If we get below 65 and confirm, the downside target is $35 a barrel on oil. With the negative GDP growth and Mr. Market starting to be like, uh-oh, and bonds getting a bid, this is the year of the dragon. This is the year of the bond king. It's playing out right before our very eyes, friends. So be careful out there with your investment decisions. So what does Dr. Copper have to say about all of this? Dr. Copper has been very undecided at this moment. I think Dr. Copper might be waiting for Friday's unemployment report. I mean, if we get like a spike in unemployment, and that's clearly like getting that second wave to the upside, Dr. Copper will crash here. If unemployment starts curling over and going down, then Dr. Copper doesn't need to worry as much. But as it stands, I think Dr. Copper's waiting for Friday. Let's see what happens. Despite what some of my watchers may think that I might be a perma bear, I'm not a bear on all risk assets. There are risk assets out there that are very, very clearly very undervalued to me. And one of them is Chinese equities, K-Web being my favorite fund to be in. And we're still in this bull flag. It's holding up its structure. This is all, by the way, while the U.S. markets are getting quite volatile here and bonds are getting a bid, and this is just continuing to develop in this bull flag formation. It'll be really interesting to see what plays out. I mean, it would be odd for the stock market in the U.S. to crash like really bearish, and then Chinese equities at the same time to get a bid. But at the same time, it might make sense. We might get some momentum. I mean, after all, a lot of momentum traders just want the hottest, newest thing. Oh, China's going up. Let's just dump all our money into China now and ride that wave. Very exciting times in markets right now. Probably should have brought this up right after showing the VIX, but we have an inverted VIX futures curve now. And so this is Mr. Market saying, options contracts are more expensive on the shorter end of this curve here, which means like we're in panic mode as it stands right now today. This can indicate continuing volatility, because when this is inverted, it means that the market's currently saying, oh, well, it'll be better maybe in April and May and June, looking out a few months. Last few charts, high yield corporate, high yield credit spreads, they're starting to look more bullish. Look at this end here. I'll just scroll into this very end here. We now have a pretty sustained pattern of higher highs, higher lows, higher highs, higher low, higher high, higher low, higher high. This looks bullish now. And with the VIX up and credit spreads starting to widen, I'm starting to sense this is likely to be the beginning of a larger correction in risk assets and run to safety. And apparently more so in bonds than gold at this point, especially considering how much of a run gold has gotten, like I showed at the beginning of this video. That is compared to its TIPS counterpart. It's all TIPS is part of the bond market. And then last chart for today I want to share again is this is a chart I bring up often, the 10-year break-even inflation rate. What is the smart money? What is the bond market betting on inflation averaging over the next 10 years? This is going down. Many people, after we had the first 100 basis points of cuts from the Federal Reserve, we had the 10-year note yield going up and up and up, and we're going straight back down. And now the TIPS market is looking like it's it's not going up anymore, at the very least. As of today, we're now at 2.36 average inflation for the next 10 years. This might be it. This might be the year the bond kings rejoice. And, but who knows? What do I know? What does he know? I'm just a guy with a crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching. And thank you so much for all the support. Much appreciated. See you next time. Robschild.